Okay, good afternoon, everyone, and welcome to the Aero East Coast Income Advantage Fund Q2 webinar update. My name is Mark Purdy. I'm the CIO of Aero Capital, and I'll be your host for today's call. I want to thank everyone for joining us. We always appreciate the opportunity to give you an update. Our special guest today is Mike MacBain, who is the founder and CIO of East Coast Asset Management. Mike will give you an update on the fund, an overview of the market, how the fund's positioned, and how he sees the rest of the year playing out on the fixed income side. We all know that 2022 was a pretty challenging year for fixed income, with a lot of fixed income funds down high single digit or even double digit negative returns. And the East Coast Fund managed to eke out a positive return of over 2%. And in 2023, the fund's up by just over 3% as of last night, and has a running yield of over 9% on the investment grade bond side. It has very good comps relative to others in the fixed income space, and we think it's a pretty good solution. We have over 400 million, just almost 400 million in the liquid alt, and appreciate all your support this year. Our sales have been very strong, and with that, we'll have a Q&A, time for Q&A at the end, and I'll turn over to Mike.
Thanks, Mark. Much appreciated. Good lead in, because I'm going to spend a few slides talking about how we managed to eke out a positive return where everybody else was red. Won't spend too much time on that, and then we'll spend quite a bit of time on what the opportunity is right now and what's going on specifically in the market right as we said. So first, just a high-level introduction. So, what we do differently from other people, we don't take any interest rate exposure, or take very minimal interest rate exposure. It's hard to get to zero, but we take minimal interest rate exposure. We optimize where we take our credit exposure on the credit curve so that we're maximizing the return we can get from every unit of credit duration or credit beta that we take. And that's one of the reasons why it's such an efficient strategy. And then last point here, just the liquidity of assets, Canadian investment grade bonds, next to government bonds, the most liquid asset in the market. So just because our returns look like private credit returns, we're not that. We're not an illiquid product like the private credit market is. Just a quick snapshot on returns, just with a handful of different funds and strategies. So ours is in green. XGB is a government bond index, XCB is a corporate bond index, the dark blue one's Manulife, the middle blue one's PIMCO, and then PHNM high yield. Just kind of trying to get a snapshot of the fixed income landscape overall and trying to give people an idea of where we fit in. So April month to date, 130 basis points versus all the others a little bit less than that. Year to date, certainly holding our own. Year to date, we've been in a market which has very much favored those funds that own rate duration. So, it's the first time in a long time that the traditional bond fund has had a benefit from rates falling, but they've fallen quite a lot this year. So that's allowing them to hold their own in the short term. And then on the right-hand side, 5-year cumulative returns really gives you a better picture of the power of our strategy and how we've been able to compound interest and not get exposed to that interest rate exposure when it comes up to bite you. So up over 20%, government bond index basically flat, corporate bond index up 7% over 5 years, Manulife the same, PIMCO slightly higher than that. MPHN high yield fund, slightly different asset class, but still in the fixed income landscape in Canada, the closest to matching our returns. So let's talk a little bit how we isolate credit spreads and why we get such a high return. So first of all, this slide just to talk about how we break out the return. So first of all, it starts with the money market yield or the risk-free return we get on cash. we haven't really talked about this very much over the last 5 or 10 years because it's basically been zero. So it hasn't really been worth talking about. But now that money market return is in the 4 to 5% range, it certainly makes a big difference on our return. And given the shape of the yield curve is very inverted, so that puts us in a better spot because we're earning the money market return, which is the highest on the yield curve right now. Then the next portion of it is we earn a credit spread carry, and we earn a credit spread roll down, and that gives us the total return in our portfolio. So I'm going to talk a little bit about credit spread carry and credit spread return on roll down the next couple of slides. But that's really how we make up our return. So here is how we isolate that credit spread and get that credit spread return. First thing I do is I go and buy this corporate bond, and let's call that an RBC bond, yields 5% in this case. If I take the close off that bond, it's got 2 risks and 2 return characteristics. The first one is interest rates, or the government of Canada yield for the same maturity as that bond. And the second is the credit spread that, in this case, RBC has to pay me in order to get me to buy their bond instead of just buying the government bond. So simply put, all I do is short that government bond, and that eliminates that interest rate exposure. So again, in this example, the government bond yields 3%. If interest rates go from 3% to 4%, the yield on the corporate bond is going to go from 5 to 6. I'm going to lose 100 basis points on my long position. I'm going to make 100 basis points on my short position. Net, there's been no P&L impact, and I'm just left with that credit spread piece. And that's the piece of exposure that I want, because it's not correlated to interest rates when everything else in today's market is correlated to interest rates. Secondly, we're looking to take advantage of the shape of the credit curve. So most people in the Canadian market, they invest at around about the index duration, which is quite often a 10-year bond. That's where the credit curve is the flattest, where you earn the least amount of return for rolling down that credit curve. So we position ourselves around the 2 and 3 year point because that's where the credit curve is the steepest as you roll down that credit curve. So what that means is that my portfolio is a portfolio of 2-year bonds. I gear that portfolio in a way that I want to take 10 years worth of exposure. So I buy more than 1 2-year bond. So in the case of the liquid alt, I'm using 3 times leverage on these 2-year bonds. I'm getting into a situation where the return on my fund is about 200% the return of a traditional, from a yield standpoint, of a traditional bond fund. And I'm taking about 75% of my risk, right? With 3 times leverage, I'm about 5.5-year duration versus a 10-year bond, which is about an 8.5-year duration. Again, I'm earning a lot of roll down as I come down that credit curve, and I'm earning it 3 times. So the capital appreciation that I get owning 3 2-year bonds rolling down the credit curve is meaningful. And if I add those 2 things together, I'm getting about 2.5 times the return of what the guy that's getting this buying the 10-year bond. And I'm getting it with less overall duration risk. So that's just a quick sort of recap on the strategy, how we get rid of interest rate exposure, why the yields or returns on our portfolio are generally higher than our competition. And now I'm going to step into talking about, what the current environment looks like. So current environment being really March. So, things change pretty fast in March. This is a kind of a chronological chart of what happened in March to the 2-year yield. When Powell testified on the 8th of March, saying that data is going to determine how high rates are going to go. There's no conversation about rates maybe not going higher. It was just how high they were going to go and how long they were going to stay there. And at that point, 2-year yields peaked at about 5.05, 5.10. And then the day after, SVB announces they lost $2 billion from their asset sale, and 2 years plummeted, and then had another bank failure. And then 2 days after that, Signature Bank also failed. And you can see we dropped in yield from 5.05 down to 4%. Ultimately, the low in yield was on March 24th when Deutsche Bank was rumored to be getting in trouble as well. And so we had the largest drop in 2-year yields in a month in the history of the government bond market. And so I don't need to tell people on this call that that's a very challenging market for a fund like ours, because as interest rates are falling, I'm not getting any benefit from that fall in interest rates. And the likelihood of credit spreads keeping up with that fall in interest rates is pretty slim. And so, especially in the short end of the curve, when you have a bit of a liquidity crisis like this, it's a very challenging market to stand in front of. And so here's your 3-year chart of 3-year senior bank failing credit spreads. So we hit a wide in October, which was as wide as they've been since we've been in business outside of COVID. And credit spreads rallied from, looks like, about 145 into about 90 by the end of February. So credit spreads had rallied, quite meaningfully through October, November, December, January, and even February. And then in March, they widened all the way back out to where they were back in October. So we had, roughly a 40 basis point spread widening in our portfolio, which is not a great scenario for us. But fortunately, one where we managed to, keep the lights on and play defense, and did actually not too badly. But you can see how volatile that is. But now we're right back at the end of March to a scenario where credit spreads are at their wides. Opportunities are very good. I'll take you through that now. So this is a breakdown of the returns month by month since credit spreads peaked in October, and overlaid with the 3-year credit spread chart. So in October, credit spreads, they were kind of 135. They widened out to 145, and then they started to narrow. So in October, credit spreads widened 5 basis points. We made 12 basis points. In November, credit spreads narrowed by 16 basis points. We made 1.6%. In December, they narrowed by 5. We made 1%. In January, again, they narrowed by 22. We made 2%. In February, it was a big outlier. They widened by 5 basis points, and we made 1%. So that was we view that as a pretty heroic performance. When credit spreads are widening, we're still making returns like that. And then we had that blip up in March, and spreads did narrow in after that when the Fed kind of came to the rescue, and Deutsche Bank risks subsided, and it appeared that the banking crisis was over and there was not going to be no further contagion. So credit spreads did come in off the wides, but still in the month of March they widened 22 basis points, and that cost the fund 1%. But the point here is that over the period, credit spreads basically didn't do anything. They started at their in October, they're sub 140. By the end of March, they're slightly sub 130. So net, they were tighter by 5 basis points, but the fund made 5%. Okay, so that's the power of owning an investment grade bond fund like ours that has an overwhelmingly high running yield. And that running yield is just really hard to overwhelm, just really hard for the credit spreads to move enough to overwhelm that yield over any period of time. And so I think if anybody said back in October, where credit spreads were, say credit spreads stayed the same, would you be happy making 5%? You'd be very happy making 5% over that period, even though we went through this kind of roller coaster of emotions over that sort of 4 or 5 month period. And add into March or April again is a pretty strong month. We're up over like 1.2% so far in April. So been a strong start to the month or start to the year, even though we've had what looked like a very scary period in the month of March. Here's the quarterly breakdown of the yield in the fund, starting at the end of December 2021, where it was really quite low, and it was really quite low for a couple of reasons. First is we were very negative on the market and didn't have much positions. And the second was that credit spreads were really tight and you weren't really getting paid much for the positions that you had. So if you add low return and low levels of exposure, you're going to get a low yield. End of March was 560. That's more common, it'd be more similar to the average kind of yield that we've had in this fund since the beginning of its life. Credit spreads widened a lot over that quarter. Again, they widened again over June, the quarter of June. Between June and September, again, stepped up quite a bit higher. And it would have been around June where we became fully exposed in the fund and started to get bullish. And basically the yield on the fund has been pretty static for the last 6 months. And it continues to be, in that 9.5% range as of the end of as it stands currently. So, we think that that's a really, a really good kind of yield position to enter the fund. Like I said, on average, the yield in the fund's 5.5 to 5.5%. It's a great story. Credit spreads are really wide at the moment. It's really hard for credit spreads to widen so much more to really eat into that yield and for you to have a negative return over a 12-month period. In terms of break evens, you have to get out to credit spreads near where they were in COVID before you're taking a loss on a 12-month basis. So that peak here at 240-ish is kind of where credit spreads need to get to before you're going to eat into that yield and turn negative on a 12-month basis. So that's kind of all I really have to say at the moment. I think it's been a challenging year, continues to be a challenging macro environment. But the way the fund's positioned and the size of the yield in the fund really makes it a very attractive opportunity in my view. So I'll stop talking there, Mark.
Great, thanks, Mike. That was a very thorough update. As I mentioned, if you want to send a question through the Q&A, we've had a couple come in right before, probably pretty popular questions. So I'll just shoot them out. I've got two here. The first one is, how much do you pay attention to the macro landscape? And, are you in a soft landing, hard landing camp, mild recession, deeper recession? And or do you actually care?
I mean, we definitely care. We're in the medium recession camp. We think it's pretty hard to imagine with what's going on that we're not going to have a fairly meaningful credit slowdown. I don't think inflation's going away, so I think the Fed's really going to have a bit of a challenge on its hands dealing with continued high inflation and an economy that's slowing down. So my feeling is that that's not soon, even though there's quite a few catalysts that could make it soon. But I feel like we're looking at a October, November type recession, even though the economy's slowing down quite a bit to where we are now. But I definitely think that it's going to be hard to avoid a recession completely.
Okay, and then to that is how the fund is positioned today versus other periods in terms of balance sheet and leverage, and what would what event or spread movement would have you take that leverage up or down?
Yeah, I mean, the credit spreads have been pretty volatile. So you don't usually get 40 basis point moves in credit spreads, more than once every year or so. And we've had a 40 basis point move and a 40 basis point move back up in 5 months. So, that creates lots of kind of mini opportunities. So, when the SVB thing started and the bank contagion started and credit spreads widened, especially in the short end, we took our risk up a fair, not a ton, but we took our risk up maybe 20%. And so, we're now taking that risk down as credit spreads have narrowed. They narrowed in the end of March, and they're continuing to narrow in April. So, we're still overall pretty bullish the level of credit spreads, but we're pretty active in terms of with that overall kind of backdrop. We're pretty active that when credit spreads narrow, to take risk off and play around the edges with kind of 20, 30, 40% of our exposure, which I think is one of the reasons why we only lost 1% last month. Like if we just held our credit exposure and credit spreads were wider by 22 basis points, we should have been down 2.5%, like some of our competitors.
We have a question from the audience. Pretty straightforward. What is the net yield if the gross yield is 9.3%? Is net less the MER and cost to borrow, i.e. cost of shorting government Canada bonds?
Yeah, so then the net number, the 9.3% number includes the cost of financing the portfolio, borrowing the government bonds, so it would be just less the MER.
Yeah. Great. Thanks for clarifying that. The management fee on the fund is 95 basis points with a 15% performance fee. So pretty competitively priced. It doesn't look like there's any further questions at this time. So we'll keep it nice and tight, conscious of everyone's time. So I want to thank Mike and everyone else for joining. So just to summarize, fund has over a running yield of over 9%, short duration product, investment grade bonds, daily liquidity, and as we've noted, compares very favorably in the fixed income universe. So I think it's a really good complement to any fixed income funds that are less active on the duration side. And I want to thank Mike for joining. Thanks everybody else, and have a great rest of your week. Thank you.